Tips on business wealth allocation and distribution. Introduction. This video presents practical tips for allocating and distributing business wealth effectively. We explore strategic methods to manage company resources, improve stability, and drive sustainable growth. We also examine how wealth decisions impact operations, employees, investors, and long-term plans. By the end of this video, you'll understand how to allocate wealth for financial health and expansion, balance reinvestment, debt management, and stakeholder returns, avoid common mistakes in financial distribution. For instance, a Nairobi-based digital marketing agency invested 60% of profits into expansion, hired new staff, and boosted productivity. Similarly, multinational firms like Amazon reinvest a majority of their profits to support rapid innovation and global growth. Defining wealth allocation and distribution. Wealth allocation is the strategic decision-making process that determines how a business spreads its capital across operations, debt reduction, savings, or investments. Wealth distribution involves sharing profits or earnings with business stakeholders, including owners, shareholders, and employees. Main objective: sustain financial health while ensuring fair returns and reinvestment for future growth. Why wealth allocation and distribution matter. Proper wealth allocation supports daily operations, long-term projects, and unforeseen expenses. Helps businesses fund expansion into new markets or develop new products. Fosters trust and loyalty through transparent profit-sharing practices. Mitigates financial risks through smart allocation across multiple channels. In Kenya, companies like Equity Bank allocate profits to digital infrastructure and also return value to shareholders, reflecting a dual growth and stability model. Key areas where businesses allocate wealth: operating capital, payroll, rent, stock, and other day-to-day needs. Debt repayment, clearing loans to improve creditworthiness. Growth investments, funds for scaling up, marketing, or launching new products. Reserve funds, safety nets for economic shocks or seasonal downturns. Employee incentives, bonuses, benefits, and other motivational rewards. A manufacturing firm in Eldoret used a portion of annual profit to buy new machinery while setting aside cash for unexpected machinery repairs. Wealth allocation strategies. Strategic allocation. Allocate based on specific business goals. E.g., 60% toward growth, 20% for operations, 20% for reserves. Conservative allocation. Focuses on paying off debt and building savings before expanding. Aggressive allocation. Prioritizes reinvestment and expansion, ideal for startups and high-growth sectors. A Nairobi fintech startup used aggressive allocation in early years, investing heavily in customer acquisition and app development. Applying the 70-20-10 rule. 70% for growth and operations, marketing, R&D, recruitment. 20% for debt reduction and cash reserves. 10% for dividends or bonuses. Why it works. Balances reinvestment with liquidity and stakeholder satisfaction. Many family businesses in Kenya have started adopting this model, inspired by structured international practices from companies like Google, which limits dividend payouts in favor of massive R&D budgets. Smart distribution of wealth. Distribute based on performance, not habit. High profit years may allow for higher distributions, while slow periods demand conservation. Understand stakeholder priorities. Some may prefer reinvestment over immediate returns. Be mindful of tax consequences tied to dividends or large payouts. For example, a Machakos-based agribusiness reduced distributions during drought periods but reinvested in water harvesting systems to future-proof operations. Common methods of wealth distribution. Profit distribution, direct payments to owners or partners. Reinvestment, channeling surplus into product lines or geographic expansion. Dividends, periodic payments to shareholders based on performance. Employee bonuses, rewarding staff for achieving business goals. Debt payments, using surplus to eliminate liabilities and increase flexibility. Safaricom distributes shareholder dividends annually while also maintaining heavy reinvestment in 5G infrastructure and innovation. Reinvesting for growth. Why it matters. Builds long-term value. Improves operational capacity. Positions the business to compete globally. Key reinvestment areas include research and development, new services or product upgrades. Marketing, growing brand reach. Technology, streamlining systems and automating tasks. Talent acquisition, hiring experts to scale operations. For example, an Eldoret logistics firm reinvested 30% of annual profit into upgrading tracking systems, cutting delivery times by 20%. Balancing short-term and long-term needs. Short-term, salaries, supply chain needs, and daily operating costs. Long-term, expansion, infrastructure upgrades, and product innovation. Balance is key. Avoid starving your operations while pursuing future projects. Ensure growth does not come at the cost of present stability. Unilever globally balances these two by maintaining strong day-to-day production while launching innovative eco-friendly packaging projects. Wealth allocation for risk management. Spread assets across multiple categories: real estate, treasury bonds, equities. Maintain a reserve fund for unexpected legal, environmental, or political shocks. Use insurance to shield the business from losses in revenue or property damage. In Kenya, more SMEs are now setting up emergency funds following disruptions caused by COVID-19 and recent tax reforms. Avoiding common mistakes. Skipping reserves leaves the business exposed during crises. Overpaying debt can restrict growth capital unnecessarily. Ignoring employee value, demotivated teams can impact productivity. Neglecting tax planning leads to reduced profitability through penalties or inefficient structures. A transport company in Kizii faced penalties after failing to plan tax-efficient bonus payouts, hurting its profitability. Best practices for effective allocation. Define financial objectives clearly: growth, liquidity, or dividends. Use a phased approach: first cover operations, then reinvest, then distribute. Monitor and forecast cash flow constantly. Involve financial advisors to plan for taxes and compliance. International companies like Apple hold massive cash reserves but still return billions to shareholders, demonstrating the value of a well-rounded strategy. Sample allocation strategy. Scenario: a Nairobi-based interior design firm makes 10 million Kenyan shillings in annual profit. Allocation strategy: 7 million Kenyan shillings, 70%, reinvested into hiring staff, acquiring new tools, and marketing. 2 million Kenyan shillings, 20%, reserved for debt clearance and emergency buffer. 1 million Kenyan shillings, 10%, distributed as bonuses and dividends. Outcome: the firm experiences 40% growth within 18 months. Maintains strong morale among staff. Avoids cash flow shocks during seasonal demand changes. Conclusion: wealth allocation is more than budgeting, it's a blueprint for business sustainability and stakeholder value. The most effective approach combines reinvestment, protection, and reward. Regular reviews, clear financial goals, and strategic risk planning ensure your business remains resilient and forward-looking. Final thought: allocating and distributing wealth wisely is one of the most powerful tools a business has. Done right, it creates stability, inspires growth, and keeps employees, owners, and partners aligned. Don't leave your finances to chance. Plan smart, invest wisely, and distribute purposefully. Thank you for watching.